Hello all. Thank you for joining us for the final session of the day. My name's Iden Asl. I'm a partner in the Special Situations and Litigation Funding team at Brown Rudnick. I'm excited and privileged to be moderating a great group of panelists on the topic of secondary market opportunities. So on the panel we have Ben Moss, Litigation Finance Portfolio Advisor at Orchard Global, Patrick Rode, Senior Legal Counsel at Deminor, Ben Smyth, Head of Secondary at Therium Capital Management, and David Vanaskey Jr., Senior VP in the Global Cap Markets and Agency Services team at Wilmington Trust Company. So at last year's conference, there were isolated discussions about the secondary market in the context of other panels. We've heard a little bit about secondaries in some of the earlier panels today. So today, we thought we would actually have a session dedicated to it. A secondary transaction can take many forms. So to frame our discussion for the next 45 minutes or so, I'd like to start by asking the panel what their understanding of a secondary transaction is in the context of litigation funding. Ben Smith, perhaps I can come to you first. Take us away.
Sure, and look, thank you for having a dedicated panel on secondary as well, and not just because it's the area I'm responsible for at Therium. Look, I think a functioning secondary market is critical really for the asset class to evolve and to become kind of a mainstream alternative investment. I think it's important to know as well from a secondary transaction, it can happen at multiple different levels. So it can happen at the single case level, which we've discussed. It can also happen at a fund level or an LP level, which is what we've been terming a portfolio transaction. Theoretically, and something that's been discussed less today, is that Therium or a GP, a fund advisor, could sell our entitlements to performance returns on either a single case or on a portfolio. I think for the purposes of this discussion, and partly so we don't overlap with previous discussions, we're going to focus on single cases largely. So maybe to answer the question directly, starting with a primary transaction, that would be signing terms for a case initially where it hasn't previously received litigation funding. So secondary would then occur either in parallel with that or subsequent to that. So in terms of it happening in parallel, the original funder who's committed the funds could look to syndicate amongst a group of co-investors. Secondly, that funder could subsequently look to exit at a later date. That could have been intended at the outset, or it could be due to a case development or a fund development more generally. I'm also told that occasionally lawyers can go over budget. So, and when that happens, that's an opportunity to welcome other funders into the space as well.
Great. Any other views from the panel? Or that was a pretty comprehensive answer to kick us off.
I think Ben, I think it's quite interesting you say that a parallel investment could be considered a secondary investment, whereas I was just thinking maybe that's a joint primary investment, but that's maybe just a minor detail. From my understanding, basically a secondary investment is any kind of transaction where one party invests into an already existing investment. So if you're saying a parallel investment, for me that sounds more like maybe a joint primary.
Yeah, when I originally pitched my title to our CIO, it was head of secondary and co-investments actually. So I think that's on that point. Yeah, I guess the way I was thinking about it is you have kind of a primary funder that is committing, and then they're looking to subsequently syndicate. So arguably there's a time lapse between.
But at a very early stage.
Yes.
Yeah. Okay, got you.
Secondary markets are very common in the capital markets transactions. The complexity of these types of assets, the sophistication of the investors makes it a bit of a challenge. I think we'll chat a little bit about that. But at the end of the day, a secondary market helps reduce costs, provides a certain level of liquidity, and reduces friction, and is certainly needed if the market is to develop down the road.
Thank you. So we are going to talk about obstacles to the development of a functioning secondary market in due course. But to start on a more positive note, it would actually be good to hear what you have seen work in the market. Ben Smith, when you're looking to invest in the secondary market? What kind of things do you look out for?
So I guess I'm going to focus again on kind of single case investments from the purposes of this question. And again, similar to some of the prior panels, it's not really reinventing the wheel. It's a lot of the things that we'd look for when we're looking at doing a primary. So I think first of all, alignment of interest is something that doesn't get impressed upon enough, I think. But alignment of interest is critical, and then you've got the likes of, strong merits, robust quantification, and realistic quantification, a reliable legal team, collectability, enforceability of the award. Then I think there's a couple of additional things that I would look at in secondary, and I think the first of those is having a kind of reliable and trustworthy incumbent investor. And that's partly because you're kind of piggybacking to some extent off of the diligence that they've done initially. But also there's a number of scenarios where they're looking to partially sell down, or they're looking to invite new funding in an upside scenario, and then you're going to be co-investing with them, so you want to be able to work in a collaborative way kind of going forward. But I think one of the key things with secondary is you should be further along the road of the investment, and therefore you should have narrowed the range of issues. There should be fewer unknown unknowns that are going to come out of the woodwork, and because of that, I think it gives you the opportunity to price more effectively and to evaluate the risk more effectively, both in terms of the merits, but also in terms of the duration, which again is something that I think everyone has tackled as being a real challenge of this asset class. So the advantage of secondary is not just that it brings the duration down, it's also that you can actually identify it more easily.
Ben Moss. Is there a type of deal or claim that you would dismiss out of hand or not be tempted to look at in kind of closer detail?
I think that there would be for us at Orchard, but I think each individual investor's sort of risk appetite, they might have a slightly differing view. So I think there are certainly some landmines in the way that if you see them, you might sort of, I would urge a bit of caution. And there's probably three that it's worth sort of bringing to your attention. And I'm using an expansive definition of secondary markets, so not just a single claim. It could be a portfolio of claims, or it could even be a strip of a fund's portfolio of investments. And the first one that's critical is it sort of, beware lack of diversification through any kind of adverse selection by the front funder. Are the legal assets in questions ones that are stuck? They're the unloved ones that haven't resolved throughout the fund life cycle. And they might actually pose more challenges rather than you knowing more about them. They might be stuck and you just don't really, you have that increased volatility over both quantum and duration. So you have to be very mindful that there has been an adverse selection by the front funder because they're keeping the good stuff, and this is the one maybe they're putting to secondary. The second point is just be mindful that you're not overreaching your own investment parameters and or over-relying on the front funders underwriting when you're entering into the transaction. There's no doubt there are situations where it's really valuable to benefit, to piggyback off a front funder, both in terms of perhaps origination, they've got the network, they've originated the deal, or they built the book if it's an opt-in group claim, and secondly, they've done that primary due diligence, they've unwritten the process. The original stuff, that's actually probably all good. Like they've done the origination, that's great. You've got more certainty over the size of the book and the deal exists. So not much to worry there. But think about the underwriting. I still think you really have to do quite a high level yourself as an investor, as a secondary investor, of underwriting and diligencing that particular deal. It may be useful, for example, if you don't have much of a hard IP patent portfolio because you typically don't have the technical expertise, the relationship. So if you want a bit of exposure, it's good to do that with a trusted funder. You maybe take a slice of their portfolio. But even in that sort of warm and fuzzy example where you know the counterparty, you're doing it in the right way, you trust their process, you still need to do that due diligence to really understand what's going on and to get in, under the engine of these deals. And as I said, if you link that to the first point where there's potentially these assets in a long tail, that becomes doubly important because otherwise you're trying to underwrite assets that are very challenging. If there's a jurisdiction you wouldn't enter into as front funder, why would you enter into portfolio cases with that jurisdiction as a secondary funder, unless it's sort of within a diversified portfolio? And thirdly, again, Ben touched upon a risk alignment, structuring the deal to ensure that there is that adequate allocation of risk. So yes, buying the investment outright, 100% ownership, that can work. You really have the control there. Or you can take maybe a vertical strip of 20 to 30% of a diversified fund, and there's an alignment of interests. But we've seen deals where it's a funder on a single claim, and they just want to de-risk themselves. They want to set the purchase price at or around the sum total of their commitment on this claim, and then they're de-risked, and it doesn't really matter how long it lasts. They've got they've got cash in the bank, and they're de-risked. And that doesn't really work from a secondary investment perspective, especially if there's a sort of SPV structure where you don't have any control. You're still sitting in the background. You can't really influence the outcome of the case. To the extent you can control the case. So you can price and structure around this. Everything has a price, everything has a way of structuring and mitigating risk, but I think those are the three areas I'd always be mindful of when viewing a secondary transaction.
You mentioned jurisdiction, and just as it will be different on the primary basis, and considerations will be different, and the kind of the progress of the market in different jurisdictions will be different. It'd be very interesting to hear the German perspective. Patrick.
Thank you, Iden. Well, I think the secondary market always reflects the status the primary market is in, right? So Tobias said the German market is a bit boring. It's quite as exciting in terms of ESG litigation and collective redress. I think we can say the similar in terms of litigation funding in Germany. I think it's only just started to kick off during the last 3 or 4 years. If we look at jurisdictions like Spain, Italy, it's the same. We currently are seeing a huge influx of funding requests, though. So litigation funding is coming, but however, accordingly, the second market isn't really developed yet. It hasn't really arrived in Germany yet, which mainly has to do with the maturity of the market. So if we look to the US or the UK, where litigation funding has been around for quite some time now, we see that obviously now we also, as the primary market evolves, we also feel or see the need for secondary investment opportunities. Litigation funders who are looking to diversify their portfolios, looking to maybe have more liquidity. So basically they're in the need for other funders, for co-funders, for secondary investors to step in and help out. We have, however, seen different opportunities in the German market. So German funders or funders that are based and are active in the continental European market have been approached by secondary investors looking to invest into the German market, into the continental European market. And certainly funders are also opening up to this possibility. I think the market is evolving in Germany, it's evolving in continental Europe, and I reckon that we will see an increase in secondary market opportunities in continental Europe and especially in Germany.
So obstacles, Ben Smith, if you want to kick us off, maybe just to kind of round out the topic a little bit and go back to drivers for the development of the market. Why would you as an initial investor look to divest? We've looked at duration as one of the issues, but if you could...
Yeah, I mean, as my colleagues will probably testify, I'm generally pretty cynical, but I'm continually surprised, I guess, by the amount of mistrust in this space amongst peers when it comes to the secondary market. There's multiple rational and genuine reasons why an investor might wish to exit an investment that aren't just a fire sale scenario. But that said, there is an obvious asymmetry of information between the seller and the buyer. So it's the seller is in kind of a position of responsibility. Yes, there's kind of contractual protections around that, but as we've said before, contractual protections only go so far. But I think it's in all of our interest that we're actually able to to generate and contribute to a fully functioning secondary market. So we should all there's no point in us kind of just looking to select against each other, looking to kind of game the system. It's all going to be pretty short-lived if we do that, and we won't have many panels like this one if we do. So I think in terms of the kind of legitimate reasons why an investor may look to exit, I mean, first of all, as I said up front, it may be the intention that they're looking to exit when they originally invest, and that may be part of a kind of a systematic process selling down risk in order to kind of make the portfolio more granular, less concentrated. Or it might be that the original investor is looking to kind of take advantage of a specific point of law or a specific, procedural development in the case. We talked about bifurcation of cases between liability and quantum. Maybe the original investor just intends to take it through liability and then wants to pass on the risk at the quantum stage. Another kind of area of legitimate reasoning for exiting may be something to do with the fund. So there might be something at the fund level, even in terms of one of the LPs looking to generate cash for other reasons. There might be a change of strategy where you're looking to kind of deploy in alternative jurisdictions, or even kind of as a listed funder, you're looking to find other avenues to generate capital. At the same time, it can be because of kind of developments in the actual case itself. We mentioned kind of the additional funding requirement for budget upsizes and the like, but also it could be due to the improvement or the deterioration in the merits. But I think it's key that there should be an adjustment in the price to reflect how that risk profile has changed, and there's nothing wrong with that. But I think then it's up to the buyer to assess whether they feel that the value they're getting is commensurate with the risk they're taking at that point in time. So it's just because there has been deterioration in the merits doesn't mean that you're being selected against, doesn't mean that this is something you shouldn't touch. You've got to look at the price as well as the risk.
You touched on the issue of kind of engendering trust between potential counterparties, and in more developed markets there are best practices, standard forms, etc. to fall back on and use as an initial benchmark for discussions. Ben, have you got thoughts on development of best practices and kind of particular areas that generate issues?
Yeah, I mean, I think it would be useful to have a more established process and a more publicly understood process when you're entering into these kind of transactions. Ben's mentioned the front funders' sort of rationale for divesting. You've always got to, that's got to be visible. You've got to understand why they're looking to sell. But you also, as a purchaser, you have to understand what are your own motivations and why are you looking to purchase. And everything flows from that. And once you then start the process, issues, for example, of confidentiality. So the seller will obviously have to go through all the relevant documents to check the confidentiality provisions that they can enter into these initial discussions with the seller or potential sellers, and that's not breaching any confidence. There are normally carve-outs for other capital providers. So there's some often wording like that. There may be consent issues, there may be explicit permissions that you need to get from other investments where you're already co-funding them. It may be that you need to redact some wording to begin with until those permissions are got, but there's definitely a piece around confidentiality that you need to navigate through. But once you do have all those provisions in place, then it's a critical point, which is the sharing of the information. And here it really does feel that there is sort of a bit of a dance going on, and it's a bit of a show and tell, and front funders are very mindful that people aren't sort of sticking their noses in, having a good rummage around their sort of funds and their performances and the kind of investments. Rather, they want to test out that this really is a legitimate buyer who has an interest in purchasing the portfolio, of which there will be many examples where that would be the case. So the question is then, I've seen such a wide spectrum of that initial document disclosure. I've seen people going the whole hog, investment memo, litigation funding agreement, budgets and so forth. And then I've seen sort of heavily redacted one-pagers where it's pretty much so little information is being shown, it's hard to even make an assessment. And as a purchaser, remember going back to that due diligence point, you need to do your due diligence, so you need to be given the information. It may be that there's a two-tier approach where you give some kind of case summary, 2-3 pages to begin with for each investment or set of investments. Then you just test that the right questions are being asked, the right noises are coming back from the funder, and then if that's the case, you can then open the floodgates with the with a wider sort of disclosure and set of documents in the data room. Definitely around price. That's another black box at the moment. It's hard to price litigation assets at the front end, so it's even harder to do at the second end. Who's even going to make the bid? Is that coming from the purchaser, or is it coming from the seller? I mean, what's obviously useful is for both parties to have in mind what they're looking for, a number or a range of numbers. So that's very important, but that could really benefit from sort of best practice methodologies in terms of valuation. And then just finally, when hopefully the deal does get done, make sure that the agreement's in place as to what level of interaction do you want, having purchased a part of a legal asset. Do you want access to the lawyers direct? What level of reporting do you want? How is the claim going to run on foot? Again, good conversations and a set of sort of standards or common convention around that, I think would also be very useful.
So at the outset of the panel, we tried to define in broad terms what a secondary transaction can look like. Patrick, you made the point that co-investment, co-funding, pretty much, even if it's a moment after initial funding, can also fall into that bracket. And I know that you've been involved in portfolio funding situations. Have you seen any co-funding issues arise in that context?
Well, I find it difficult to say there are certain issues that are specific to the constellation where two funders are co-funding and co-funding into a portfolio. I think we've spoken about portfolio funding. We had a prior panel that touched on many of the issues that can occur in a portfolio funding, and I think we've also heard quite a few different issues that are specific to secondary funding. So I think all of those points are valid also in this constellation. I think the major difference is that when you're co-funding and you're co-funding into a portfolio, it's a long-term relationship you're entering into with the other funder. It's not a one-off or an individual claim, which certainly has a specific lifetime and then just ends. The portfolio can last longer and usually does last longer. And I think all of the points that have been raised are just even more important in such a constellation. The aspect of trust, of transparency, I think is super important. And the most important point to avoid any issues occurring is just finding a co-funder with the right fit, finding a good partner, finding somebody who has a similar risk appetite, maybe somebody who just fits, and I think that is just one of the major aspects to look out for when entering into co-funding.
So we've heard some perspectives from potential buyers, potential sellers. Another key player in this process and in this evolution of the secondary market are going to be the providers of the infrastructure around these secondary transactions, whether they are going to be large single cases that get syndicated out in pieces or portfolio situations, but technology will I'm sure come into play. And David, you seem well placed to comment on that.
Yeah, I think my panelists have touched very well on the transparency issues, the trust issues. Third parties, like a Wilmington Trust, need to be are trusted in this space, known in this space, and can certainly facilitate these secondary market transactions. What we can see is bringing some of the technology solutions in other secondary markets to bear into this asset class and this sophisticated space, providing safe, secure front-end interfaces where clients can self-service at their own leisure. These are multi-factor authentication for security purposes, and optimally, the clients can come in. They have access to documentation. They can upload documents. There's access to electronic or digital signatures. The collection of forms, tax forms, and other documents can be facilitated through this technology. And then at the end of the day, if and when there are disbursements or distributions, we can utilize the technology and the information that's been gathered to effectively, efficiently, costs are important, and certainly securely distribute out payments in accordance with the waterfall structure and the contract, repaying litigation funders and ultimately claim holders at the end of the day. So technology can level the playing field, provide a certain amount of trust and transparency in transactions, and trusted parties in the middle of buyers and sellers can be effective in facilitating that.
Thank you. So we've discussed in quite general terms secondary market developments, potential areas of interest, but it would be good to get a little bit more into the specifics of what kind of, in terms of format, structure, time in the litigation would you see your institutions getting involved? So, Mr. Smyth?
I mean, I think I've focused a lot on single cases in this discussion. I see the opportunity more in portfolios, if I'm honest, and I think there's multiple reasons for that, but I think this is already a heavily labour-intensive asset class,
Yeah.
and I feel like you need some economy of scale with that, and therefore, I'd much rather invest on a portfolio basis and rely on the modelling, rely on the numbers, and kind of trust the asset, rather than kind of go single case, try and diligence on top of the incumbent investor already, try and pick out information that I'm now getting third hand and try to assess that in a better way than the investor prior to me is able to do. I just don't think that's how you can get better visibility, you can get good visibility on the asset class. So yeah, I'd much rather do portfolios, and I do them as granularly as possible and rely on the quantitative analysis that you're going to do.
On a single case kind of basis, then Moss, would there be, we were saying, coming in towards the later end of the litigation when a bit more of the variables are known, any thoughts on that from an Orchard perspective?
In terms of what's attractive?
Yes.
Yeah, I mean, look, we've seen, and we've spoken about at length earlier in the morning sessions, we've seen some very large claims in the CAT. We previously saw some other opt-out claims, 19.6, outside of the CAT, and they have a real potential for to be very high value indeed, but they're high risk, they're long duration, but there's also a very clear front-end risk procedurally. Will this claim be allowed? Will it get in the CAT pass certification, or in 19.6? Will it be able to be run as a 19.6? So we may see where funders have taken that front-end risk, they've then got over that, navigated that hurdle successfully, and there may be an opportunity in the secondary market for perhaps funders who didn't really have the same amount of appetite to do that, to step in, or funders who also, because a lot of these CAT claims are effectively being co-funded and sub-funding from day one anyway, they've got their concentration limits, so they have taken that risk, but they just can't take any more of that front-end risk, but yet they still like the concept of the CAT claim, the concept of these big competition cases, so that might be a sort of second bite of the cherry for them to sort of deepen their portfolio. And I think that can be very attractive. And for sellers, again, with duration coming in, they're also potentially motivated to just get a bit of cash in the door, monetize it, because they know that actually the claim still might have quite a while to run anyway.
Okay, great. We are obviously standing between our attendees and the drinks and the nibbles, which are within touching distance. So we've got the privileged situation of being the final panel of the day, and that gives us an opportunity to give maybe some final thoughts, whether on the secondary or the primary market, and how you see things just generally going, developing, maybe what would help in terms of development of the primary market to help drive a little bit more development with the secondary. Patrick, would you like to kick us off?
Thanks. Sure. Well, I think it's an evolution. I think somebody else said this on a prior panel. It's an evolution, and I think with an evolving primary market, we will also see an evolving secondary market. And I think the opportunities will arise. And like Ben said, obviously we're all interested in making the market work and doing business. So I think it's up to us to also help the market evolve and make the best out of the opportunities. I don't think there's anything that has to change. I think we can change it, and I think we are also already seeing different opportunities and funders working together in order to make these opportunities work.
Okay.
Yeah, I would just add, generally, secondary market needs the cooperation of everybody who's involved. So whether you're first in or looking to offload that risk or liquidate your position, in some fashion, there's got to be a view for the greater good, right? And what's the overall objective here? And cooperation was talked about, transparency. I think, at the end of the day, we'd all like to see more, whether it's primary or secondary market transactions at the end of the day.
Yeah, I think somebody said at last year's conference that in all these discussions we sometimes can forget that there is an actual client at the source of all of this. And the primary market is obviously very helpful in creating opportunities to get justice for various categories of client. And we've been talking how the primary market can help the secondary, but actually the secondary, a development of that definitely will generate new entrants to the market, develop that primary market at a quicker pace. So actually it's a two-way street, and it's in the interest, I think, of the market, to the general wider market, to, as you said, David, work together to try and get a functioning secondary. I think we have some time for some questions before we wrap up this panel. So at this stage, I would invite you. I think we have one there. Microphone.
I think it was Dave mentioned the occasionally used experience on the transparency. To what extent do you feel that transparency impedes the secondary market?
Transparency leads to a level playing field of information, and I think further gives folks confidence in what they're potentially investing in. If there are standardized documents, standardized term sheets, things that folks can somewhat expect and understand, and they can then theoretically move forward more efficiently, more effectively, more timely, and that would certainly build more activity, bring in more potential investors into the opportunities in the secondary market.
Any other questions?
I have 3 questions, but they're very short. So, first of all, in terms of looking at portfolios, do you assess every case in that portfolio in the same way you would as a single case? Second question is, do you make a decision faster than you would with a primary investment? And third question is, why do you think the secondary market hasn't massively taken off? We were talking about the secondary market, 6-8 years ago. It still hasn't really taken off in the way I think that funders thought it would.
Who would like to jump in?
I can jump in with the last one. We can work on. Maybe one of the reasons the secondary market took a while to get going, and it might be a reason why it's now going to see a period of growth, and this might be quite a strange answer, but I wonder if we're now reaching a point where there may be a bit of saturation in the origination networks of some of these developed jurisdictions. How many funders does a lawyer need to know? They don't need to know 15 funders. As long as they know, they have a close cohort of trusted funders. And so that might squeeze out new entrants to the market in terms of going out and front funding, but there's still a demand for this asset class. So you might just see an increase in sort of secondary market participants. And to just bring it back to your question, maybe a few years ago, 6 to 8 years ago, there was still more growth in that primary. There was a clearer indication that there was more growth in primary funding. There were more opportunities, and maybe it's being retrenched or will be retrenched, in the course of the coming years or so.
Maybe to answer the first and second question. Sorry, Ben.
No, go ahead.
I think we all agree that obviously, when we're co-funding or investing into an investment that has already been assessed, you can't rely on the due diligence that someone else has done. Maybe somebody does, but we certainly don't. We look at every case as if it was its own investment, and we wouldn't in any way rely on what's already been done. So we always do our own due diligence, I think that.
Yeah, maybe I downplayed a little bit earlier the kind of the extent to which diligence is important. I think it does differ a little bit if you're looking at kind of a slice of a portfolio for a percentage of a portfolio versus if you're looking to acquire the whole thing. So clearly, there is a scale in terms of how much diligence you want to do. But if you're looking at a slice, I think you're basically trying to determine whether you can rely on the information you've received, both from the law firm and from the funder, if there's a funder in the middle. And then I think you can just do a screen of various things. If you want to check book builds, if you want to check information that's been disclosed, if you want to check quantum analysis, you can take a selection, and then you can have a look at that and see whether you're comfortable on the basis of that. I don't think it makes sense to do, for a vertical slice, to do the whole scale. I just think it defeats the object somewhat. So to answer your second question though, so I do think you should be able to theoretically you should be able to reach a decision quicker, because you should be able to rely on a pretty standard model of this stuff. You can do a screening of the information you've received and the cases you've received, and then it's just a case of price. So yeah, you should be able to turn that around quicker, and certainly you can turn it around quicker than if you were to fund each of them on an individual basis, kind of cumulatively. So yeah.
When you say it's just a case of price at the end, that might be the answer to the third question as well. Why these opportunities haven't been fruitful.
Yeah, I think that's true. I think the asset class generally hasn't had it's too focused on risk and not enough focused on price. And I think, that's probably something that hasn't happened. And it's really the point I was trying to make earlier. Like, just because a case is deteriorated, doesn't mean you can't touch it. There's a price that makes sense for the risk change. So yeah, and then you solve the transparency thing as well. Because if it's ultimately you're selling out at the right price, then you should be willing to be transparent, because that's fair value.
And also, when you're talking about portfolios, it's a very broad term, right? You can have a portfolio of very similar cases. You can have a portfolio of totally different cases. So in a way, obviously Ben's right. Like, some cases you have to look at every case, and some portfolios you can just look at a few maybe, yeah. Or a screen out.
Hi there, this is Luke Dice at Global Restitution Partners. One of the things I'd like to see, and I was keen to get the panel's thoughts on how we go about it, is a better mechanism for matching buyers and sellers in the secondary market. I think in the last Westfleet report there's over 50 litigation funders just in the US. How do we match? How do we even know who's a willing buyer, what's available to sell, particularly when we're dealing with a lot of highly confidential information? Is that a role for a broker, or what's the right mechanism?
Well, I think somebody said earlier that there's not going to be a public market on secondaries. I totally agree with that. I also think that the thing is, and now we're talking about pricing again, as soon as we have a broker in between the primary and the secondary investor, the whole pricing changes again. So I think that just makes it a bit more difficult. So I personally don't think that there's a lot of room for a broker in that constellation. I think the funders have a sufficient network to be able to find a co-funder if they're looking for somebody, but I might be wrong. I don't know.
Yeah, look, I mean, to some extent, it's always going to be an OTC asset class. I think for secondary, it's just so esoteric. But that said, the more kind of the more monoline stuff, if you want to trade books of emissions portfolios, whatever it might be, that's more standardized, and maybe in that space you can get to something akin to a public market. But yeah, I think it's events like this, and information sharing, and talking to each other, finding out what's out there. It isn't that big a market, and I think we'll just have a better feel, and it will help engender trust as well amongst us. The more conversations we have.
But also, I mean, there are some specialist secondary market funders in the market now. If you look at GCP, Gertrude Capital Partners, as I understand it, that is all they do, or certainly that's their primary or secondary, both primary and secondary focus. Their primary focus is on the secondary market. So if you have an asset to sell, or whether they'll be your first port of call, I don't know, but you know that there is a potential ready-made home there. They've got a big war chest, as I understand it, and maybe that we'll see other funders like that coming into the mix, and they'll be the go-to. So whether you need an intermediary sitting in the middle, maybe you do outside of that, but with those guys, maybe you don't.
Just a quick one. It's very coy listening to these funders not sharing their technology in an OTC market. We've been looking at trying to sell a secondary strip of exposure to 8 claims and 5 funders. And one of the things we've thought about is going to the insurance market to lay off this bid-ask spread, and also the issue around mutual disclosure. I wonder if the panel had any thoughts about, if you were a seller whose motivation was solely to monetize, is that a solution in terms of just offering effectively an insurance-backed strip. So the insurer does the diligence, the buyer doesn't see essentially the underlying documentation, and they're buying balance sheet risk from the insurer. Is that a solution?
Yeah, I mean, I think we've talked about insurance as being a solution for that. I mean, it does solve to some extent the kind of transparency issue, but I think we also admitted that insurance isn't there's no alchemy to it. You know, there's a cost, and yes, you're trying to take some risk off the table, but there's still, you're paying a price for that. So you're not solving everything, but certainly for the sharing of information, if that's what helps two counterparties get comfortable, maybe that is helpful. Yeah.
So if there are no further questions, I'd just like to take the opportunity to thank the panel for sharing their knowledge and expertise with us. I believe there is, Eleanor will be giving some closing remarks, but for now, if we could just round of applause for our panel, please.
Just very quickly before the drinks. I'd like to say a huge thank you to all of you for coming today, to our amazing keynote speaker, Iden Asl, to my partners at Brown Rudnick who helped me to moderate the panels, and to Questa Consulting, our PR company, who has been helping to put this conference together. And again, thank you to all of you for your engagement. We hope that you have found today stimulating, and that you have had the opportunity to catch up with colleagues and meet new partners in the industry and make new contacts. It has been an honor to have so many of you and so many thought leaders in the litigation funding space, and to have all of you together in this forum. I know some of you have your flights to catch, but for those who don't, please join us for drinks and canapé in the other room. Thank you.